All right, let's dive straight into this explainer. Today, we're putting on our investigative analyst hats, pulling up the digital forensic whiteboard, and figuring out exactly how to protect your hard-earned capital from corporate fraud. Seriously, if you've ever worried about a stock in your portfolio just suddenly collapsing overnight, this is absolutely the most important explainer you'll ever watch.
Picture this. It's 2009, and Satyam Computers is an absolute titan. I'm talking a top 5 Indian IT giant. It was a total market darling, the kind of core holding you felt completely safe passing down to your kids. But then, in January of that year, the chairman confessed to something just unthinkable. They've been aggressively cooking the books for years. Get this, a massive 7,800 crore rupee profit was entirely fictitious. Literally just numbers typed on a screen. And the fallout? 90% of its stock value was wiped out almost instantly. Imagine waking up, checking your brokerage app, and finding your investment practically vaporized before you've even had your morning coffee.
So that brings us to the million-dollar question, right? Could spotting this disaster have been possible before the collapse? The answer is a definitive yes, because here's the secret of the markets. Governance signals, those early warnings of impending doom, they're almost always hiding right in plain sight. We just have to train our eyes to spot them before the broader market does, so you never end up holding the bag. Here's our investigative roadmap for today's explainer. First, the Satyam crime scene. Then, the 10 red flags. After that, case study autopsies, followed by the red flag hierarchy, and finally, your ultimate checklist.
Let's kick things off with Section 1, the Satyam crime scene, and ask what exactly is corporate governance?
Moving on to Section 2, the 10 red flags. It's time to build our toolkit. All right, as we start pinning things to our whiteboard, let's group our first set of red flags around auditors. Corporate governance is basically the rule book for how a company is run and how minority shareholders, like you and me, are protected. And the auditor? They're supposed to be the ultimate independent referee. So, if an auditor suddenly resigns instead of signing off on the financials, like Deloitte did with Manipasan Beverages back in 2018, right before the stock crashed 99%, that is a nuclear red flag. You avoid that stock completely. Similarly, if an auditor issues a qualified opinion, which means they're formally flagging unresolved concerns in the annual report, that demands serious investigation. You run, not walk away if management can't give you a bulletproof explanation.
Next up on the board, we've got the promoters themselves. We absolutely cannot let them trick us with quiet maneuvers. For instance, if a promoter pledges more than 50% of their personal shares to banks as collateral for a loan, that is a glaring sign of massive, systemic financial stress at the top. We literally watched this exact behavior destroy massive entities like the Anil Ambani Group and DHFL. Also, keep a super close eye on their actual skin in the game. If you notice promoters quietly selling off their stakes over consecutive quarters without some crystal clear, logical merger or acquisition reason, like what we saw leading up to the collapses of Suzlon and Yes Bank, they are rushing to the exits. And trust me, you don't want to be the one left sitting inside a burning building.
Now, let's break down the exact mathematical illusions Satyam pulled off because it's wild. Think about the pure logic here for a second. A company claims to hold massive amounts of cash, let's say 5,000 crore, sitting safely in a bank earning maybe 5% interest. But at the exact same time, they're going out into the market borrowing 3,000 crore and happily paying 9% interest on that new debt. That creates a totally illogical financial mismatch. They're practically guaranteeing a loss of 120 crore a year just on the interest difference. No rational profit-seeking business on earth actually does this. The only logical conclusion we can draw as analysts is that the cash they're reporting simply isn't real. If cash makes up more than 30% of their market cap, but debt just keeps rising year over year, be very, very afraid.
Here's another mathematical red flag hiding right there in the financials. If a company's receivables, which is just the money owed to them by clients for stuff they've already delivered, is growing incredibly fast, you've got a serious problem. The rule of thumb we use is this. If receivables are growing more than 1.5 times faster than actual top-line revenue, it's a massive warning sign of aggressive, potentially fake accounting. They're likely doing something called channel stuffing. That means they're aggressively pushing inventory to distributors without actually getting paid for it, just to make the current quarter's sales numbers look amazing to Dalal Street. We saw this exact tactic used by companies like Vikranji right before the bottom fell out.
Rounding out our 10 flags, we need to be incredibly suspicious of the corporate structure and the management team themselves. First, watch out for related party transactions, or RPTs. This essentially means management is doing business with their own private side hustles. If those deals exceed 10% of revenue, avoid it. They're probably round-tripping your profits right out the back door. Second, watch for revolving door CFOs. If the financial conscience of the company leaves more than once in a 3-year span, something is deeply wrong inside that building. Third, beware of companies hiding debt in excessive subsidiaries. Anything over 30 separate entities needs a very careful forensic examination. And finally, check the board of directors. Independent directors who are just retired bureaucrats with no business sense or just lifelong family friends of the founder are totally useless when it comes to protecting your money.
All right, Section 3. Case study autopsies and patterns of collapse. When we run the autopsy on IL&FS from 2018, a wild pattern emerges that perfectly aligns with our whiteboard. They used an impossible-to-track web of 169 separate subsidiary companies. I mean, why would a legitimate business need that many? Simply because complexity is the ultimate hiding spot for fraud. They used these subsidiaries to hide a staggering 91,000 crore rupees in group-level debt entirely off the main balance sheet. By the time they started missing routine debt payments and the rating agencies finally downgraded them, the general public was caught completely off guard. But for an investigative investor, that red flag of excessive, convoluted subsidiaries was waving aggressively the entire time.
Let's pivot and look at Yes Bank in 2020. The crucial point here revolves around the personality factor at the very top. Founder Rana Kapoor absolutely refused to step down from leadership despite direct mandates from the Reserve Bank of India. When a founder clings to power that desperately and actively fights regulators, they're almost always hiding deep, systemic issues they know will be uncovered the second they leave the building. Combine that stubbornness with non-performing asset disclosures, essentially their bad unpaid loans, that were magically reported much lower than what the RBI actually found during audits. Add in highly concentrated lending to deeply stressed corporate groups and dangerously high promoter pledging, and you had a ticking time bomb just waiting to detonate retail portfolios.
For DHFL, between 2019 and 2021, the lesson is incredibly stark. Back in January 2019, a Cobra Post investigative expose alleged massive, coordinated round-tripping of funds. Now, add to that the fact that the promoter family had an insanely high percentage of their own shares pledged to banks. And they were constantly having loud public disagreements with their auditors. Remember our nuclear rule from earlier? When investigative journalism points directly to massive related party deals and the very auditors hired to verify the books are aggressively pushing back, you absolutely do not wait around for the official collapse to be announced on the evening news. You take it seriously, you trust your gut, and you walk away immediately.
Moving into Section 4, the red flag hierarchy and your warning system.
So, we've seen the flags, and we've analyzed the collapses. Now we have to process all these scattered signals into a usable, emotionless warning system to protect your portfolio going forward. Think of it like a strict hierarchy of rules. Tier 1 triggers are nuclear. If an auditor suddenly resigns, issues a highly adverse opinion, or a promoter gets arrested, you drop the stock immediately. No second thoughts, no hoping for a bounce. Tier 2 demands a full pause and serious investigation. This happens when your auditor qualifies an opinion, promoters pledge more than 50% of their equity, you spot major related party transactions, or the CFO suddenly vanishes. Finally, Tier 3 puts you on high alert. Things like 25 to 50% pledging, receivables growing a bit too fast, or a maze of unnecessary subsidiaries. You can hold, but definitely keep one finger hovering near the sell button.
And finally, Section 5, the ultimate checklist, which is basically your self-defense weapon.
To close out our investigation today, let's put together the ultimate self-defense weapon. This is a 10-point checklist that you need to run through quarterly filings and annual reports before you ever allocate a single rupee. First, we demand stability and absolute cleanliness. We check the promoter pledge. Is it safely resting below 25%? Next, we look at the auditor. Have they been consistently reviewing the books for at least 3 years, proving there's no shady auditor shopping going on? We also need to ensure their audit opinion is completely clean and unqualified. Then, we verify that related party transactions are safely kept under 5% of total revenue. And finally, we look at the CFO. Are they stable, acting as a reliable financial conscience, or have they been jumping ship right before earnings calls?
Moving to the second half of our defense system, we check the underlying structure. We want to see if the promoter's holding is stable or actually increasing, which is a fantastic sign they truly believe in their own company's future. We also need to make sure receivables are growing logically, perfectly in line with actual cash revenue. Then, we check the corporate layout. Is the subsidiary structure manageable, ideally well under 30 entities? We also verify that the board of directors actually has teeth, packed with highly qualified, truly independent directors who aren't afraid to push back on the CEO. And lastly, we do a quick sanity check to ensure there's a completely logical, mathematical balance between their reported cash in the bank and the debt they're actively servicing. Once you've got your answers, you grade your target stock rigorously out of 10. If it scores a 9 or 10, you're looking at genuinely strong governance and a safe place to park your capital. 7 or 8 is acceptable, but you'll definitely need to keep monitoring it. But if it drops below a 7, you need to proceed with extreme caution and start asking some really hard questions. And if it scores below a 5, do not let management trick you with glossy PDF presentations or grand promises of future exponential growth. A score below 5 means the core structural integrity of the company is fully compromised. Simply avoid it. Everything we've uncovered today really boils down to one simple, unavoidable rule. Each red flag is significant alone, but deadly together. As we learned from the massive Satyam shock, the incredibly dense IL&FS hidden debt trap, and the Yes Bank collapse, corporate ruin is almost never a sudden, unpredictable accident. It's always a slow, steady compounding of these exact, ignored warnings. The smoke is always there before the fire.
So the ultimate question is this: will you let the next massive corporate disaster quietly take your money, or will you read the signs on the whiteboard and protect yourself? Keep this warning system handy and run your portfolio through it this weekend. In our next explainer, we're going to pivot and tackle investor psychology, building the exact emotional discipline you need to actually act on these red flags when the broader market is caught in a buying frenzy. Until then, stay vigilant, stay analytical, and as always, protect your capital.